Viewpoints on the talk station FM 107 AM 1240. It's an opportunity this afternoon to chat with Matt Dodge of the Estate Planning Center. Well, actually, Market Street Wealth Management at the Estate Planning Center. We're sort of doing a little clarity there. And as always, to remind you as we prepare to talk to Matt, that Matt is a registered representative of and securities are offered through USA Financial Securities, member FINRA, SIPC, a registered investment advisor. Matt Dodge is an investment advisor and representative of Market Street Wealth Management, a registered investment advisor. At the Estate Planning Center, Market Street Wealth Management and USA Financial Securities are not affiliated. And with that, Matt, good afternoon to you. Thanks for taking the time to be with us.
Good afternoon, Lockwood. It's been a nice break in the cold weather.
Oh, boy.
It's really good outside. So.
Has it ever? It's been beautiful. But unfortunately, I think we're looking at some cold weather just around the corner. You know, with that said, since we're looking at weather, another issue always has been the topic of, well, planning and estate management and things of that nature. Of course, that's what you do there at Market Street Wealth Management, part of the Estate Planning Center. And I'm wondering, we've been talking here recently about, the habits of good investing and good, management, long-term management. We were chatting last week about the issue of investing with a purpose. And in light of the weather, and bringing that into the conversation, one wonders, how do you go about investing when you've got so many variables, such as the weather? I mean, you're never really sure. I may have a goal and a plan. This is what I'm going to use my money for. But just like the weather, the investment environment, the investment climate changes, and it changes radically. So how do you apply your good habits to that?
Yeah, you're right. I mean, I would say the key difference with the weather, I just immediately thought of, all right, it's cold outside. We know we need to wear a coat, right? And we're familiar with coats. We know, all right, this is a raincoat. It's going to keep me dry, probably not going to keep me warm. Mm-hmm. I need this heavier coat, yada, yada. The problem is with investing, there's just as many tools and different kinds of things, but, you can't really get your hands on them, right. And we're not as familiar with them. So, but yeah, so last week, and we're kind of in that series of 3 habits of successful investing. Last week we talked about investing for a reason, for a purpose, mm-hmm. as opposed to kind of just simply investing and hope it works out, but really rather to define the job duty of each investment. And today I wanted to discuss the actual investments themselves. If you remember, the second habit was make unemotional investment decisions. So we're actually going to dive into the investments themselves, and I want to break it down into 2 sections. The first being the actual type of investment, mm-hmm. and secondly, the process that that specific investment uses to either make purchasing decisions or selling decisions. So, and I'll get onto that a little bit more. So firstly, the type of investment. Now, this could be stocks, mutual funds, bonds, real estate investment trusts, annuities. That list could go on and on and on. But with all these different types, which one should we choose? For a lot of people that are kind of looking at the investment landscape, it's almost like they're visualizing throwing every investment in the world into one big funnel, and which one should pop out at the bottom that we should choose. And really, this goes back to our first habit, which is invest for a purpose. What is the purpose of a specific account? Mm-hmm. So maybe this account's job is to sit and grow for 5 years.
Right.
At which time I'm going to tap into that account for income. So what that description will dictate the investment type, because I've defined here's how much time I'm going to let it sit and defer and grow. Mm-hmm. And I've also defined when I'm going to need to get my hands on it or when I'm going to use it for income. So what you would do, how you do this in the real world, is you take that description and you match an investment to it.
Okay.
Right? Find an investment that I'm relatively confident will be safe and return my original investment plus hopefully some growth, and I needed to do that in 5 years. And also, in 5 years, I'm going to need it to be liquid, right? Does that make sense?
Mm-hmm. Right. So
you're matching up the attributes of the investment to the job duty, just like you would if you were a business owner and you had a job of, you needed a receptionist. There's obvious traits that a receptionist has that you go and match up to different applicants.
So, bringing it back to that weather analogy a few moments ago, you're investing in a stock based on the needs. You need a raincoat because it's raining outside. So you actually identify what you're purchasing. You're doing this not because it feels good, but because it provides a service. Again, removing that concept of emotion from the conversation.
Right, and you said investing in a stock. It really could be investing in whatever it is.
Yeah.
You know, some cases, a money market account's the best thing you need to do because you need this money safe, you need it liquid, blah, blah, blah.
Mm-hmm.
You know, so
right. Okay.
It's tying those together. But, yeah, you're absolutely right. Now, the second part of investing unemotionally, this has to do with more of our long-term growth investments, and that's normally going to mean the stock market.
Mm-hmm.
I've said in the past that God couldn't have created worse investors if he tried, because as humans, we are what? We're very emotional. We get excited when things are going good or the stock market's going up, but when the market goes down, we get depressed. The opposite is true. So the market is often like a roller coaster, and without a process, our emotions are going right up and down that roller coaster. So we believe that there are times to be invested in the stock market and times not to be. And I think most would agree with that. But I don't want to confuse that. I'm advocating for market timing because that's not what I'm doing. That's where you buy and sell quickly. You look to profit off of short-term movements in the market, and it's very, very difficult to be consistent at that long-term. But what we actually believe in is looking at long-term trends, trends in the market, and making decisions based on those. And how we do it, and the key is that we have a preset list of rules or criteria that's going to dictate, what's bought, what's sold, and whether or not we should even be looking at, in this instance, stocks. Maybe we need to go to another asset class. And we're typically do that on a monthly basis. And what it does, it's going to remove that human emotional element. And like I've said in previous shows, emotions are kind of attributed to as the reason why investing can be so difficult and why, as the average investor, they have, they study this. There's a Dalbar study that comes out every year and shows the average investor returns much lower than the actual stock market does, and they attribute that to emotions or bad investing behavior.
We're talking with Matt Dodge of the Estate Planning Center, Market Street Wealth Management, part of the Estate Planning Center. I'm going to get this correct at some point in my career here on the program. Matt Dodge, of course, with Market Street Wealth Management at the Estate Planning Center. And by the way, if you want to get more information about this topic or other topics we've discussed over the past couple of months, 252 area code 240-2400. That's 240-2400, or go online to estateplanningctr.com. That's short for center, estateplanningctr.com, to get hold of Matt Dodge. Matt, looking at these, again, the three habits. First habit being intentional investing. You're investing for purposes. Second habit, removing the emotion. And of course, the third one we'll touch on at a later time, planning for the worst and celebrating the best. This whole aspect of investing, you're talking to your clients. That's one of your jobs, I would assume, is, getting you get the buy-in without the emotion. In other words, I agree I need to do something planning, but I don't need to be looking at it emotionally. So that seems to me be pretty tough at times because everybody walks in. Those are hard-earned dollars. I want to be very careful with them, or I want to make great millions of dollars in investing. And somewhere in there, you're trying to say, wait a second, let's first do this for a purpose, and then secondly, let's do it very coolly and calmly. Am I pretty explaining?
Yeah, and I think there's a gentleman that I admire a lot, economist Thomas Sowell. He put it the best. It says, "Look, there's no actual solutions. There's only trade-offs. So there's trade-offs in everything, right? So to get this, I've got to be willing to give up some of that. So to get a higher return, typically I got to invest in something a little bit riskier. So the trade-off is, well, it's not as safe as, say, if I buried it in my backyard. So emotions are there's no way to get rid of emotions, but if we can get rid of it as much as possible from the investing decisions that we make, I just think long term it gives people the best chance for success.
We're talking about the 3 habits of good investing, and of course, we were talking about a few moments ago the investing for a purpose, as we've talked about last week, as a matter of fact, with Matt Dodge, and again this week talking about removing the emotion from our efforts. And if you want to find out more, again, remind you that number, 252 area code 240-2400. That's 240-2400. Or go online to estateplanningctr.com. Matt, as always, thanks for being with us this afternoon.
Oh, thank you.
And next week we'll be chatting, I guess, about the plan for the worst, but celebrate the best, I guess.
Absolutely.
Outstanding. Matt Dodge with us this afternoon. Of course, just to remind you, Matt Dodge is a registered representative of, and securities are offered through USA Financial Securities, member FINRA, SIPC, a registered investment advisor. Matt Dodge is an investment advisor and representative of Market Street Wealth Management, a registered investment advisor. The Estate Planning Center, Market Street Wealth Management, and USA Financial Securities are not affiliated. You're listening to Viewpoints here on the Talk Station, FM 107, AM 1240.